Just going to wait for a couple of minutes just for everyone to join. Okay, I think we'll get started. We're just about on the hour. I know we've got a lot to get through. So firstly, welcome to everybody. Thank you for joining us today. I normally go off piece, but I've been given a script and I have to stick to it. So I'm going to stick to my script. It's not about me. It's about the content, the presentation, the Q&As afterwards. So apologies if I'm sticking to my script, but I'll make sure I stick to time. Welcome to our discussion today on inflation, changes in values, and managing the impact on insurance and risk management programs. My name's Nick Harris. I'm the CEO of Marsh Pacific, and I'm dialing in from Sydney office. Before we start, I'd like to take a moment to acknowledge that I'm hosting this webinar from the lands of the Gadigal, the Eora Nation. I also acknowledge the traditional custodians of the various lands on which we all work today, and the Aboriginal and Torres Strait Islander people participating on this webinar. It's great to see so many clients and names dialing in. We had 580 people positive dialing in want to join this webinar, which I think is probably one of the highest we've ever had in terms of clients and prospects, which demonstrates what an important topic it is. We're seeing a surge in inflation around the world as the dual impacts of COVID, pandemic, and geopolitical instability, including the continuing Russian-Ukraine conflict. Commodity prices are rising, goods, labor cost, and supply chain disruptions continue to dominate the headlines. As we know, at the top of mind as a CEO of Marsh here in the Pacific, but also of you are joining from all the companies around who are dialing in. The effects of the global widespread volatility is impacting us locally, obviously, as we know. Inflation reaching 6.1 in June and tipped to go above that before it hopefully comes back down. But for many of us who have joined this session, inflation's probably here to stay for the longer term and something we need to continue to plan for. And that brings us to Marsh. And here I will go off script a tiny bit, which is the most important thing about these webinars and our partnership with you is that we are risk advisors. We're advising you on risks. We're advising you on risks of now, and we're trying to give you a glimpse of the future around your risk. It's not a sales job. It's not trying to sell you something. We're partnering with you to make you understand the risks of today and give you a glimpse of the risk of the future so you can plan accordingly and make sure that your programs are accurate now and accurate in the future. And with that in mind, I just want to start with a very quick poll question, bit of audience participation here to see what the impact on your companies and the things I've just talked about. So if we just say, quick question for everybody who's dialed in, and there's a poll here, take 20 seconds. How much has your cost of business gone up? I think it's, let's say in the last, I think it's probably the last couple of years, but let's say how much has your cost of business, doing business gone up, let's say in the last couple of years? I'll give you a quick 20 seconds just to have a quick result, please. Okay, we should have an answer coming up. Freya, can we have the answer? Right, so as you can see, we've got over 12% of your business. So wow, look at that. So yeah, the bulk of you are saying your business has gone up between 5 and over 12%. So quite a scary statistic if you look at the numbers of people, how much the cost of business has gone up. In this session, the team are going to share some examples which talk about this and demonstrate how we can obviously work with this. It's not something that's unique to you all. It's unique. It's happening all around the world. But it's super important if you look at that to think about if that continues, what's your business look like in another year going forward and a year after that. Let's move on. So the other thing, which is obviously talking about the environment, it's important to understand the impact of factors driving inflation and have on your company and insurance programs. Your assets and business interruption values become very important in terms of how they're being declared, as well as how they're being evaluated. Inflation can drive up the valuation of your assets and business interruption exposure, potentially causing underinsurance. Should you be faced with a loss, would your business be able to respond adequately if that happened to you? This is the purpose of today's webinar. As your risk advisor, we want you to be fully aware of the risks of inflation and the potential impacts it could have on your insurance, claims, and risk management program. And to that end, we've gathered together some of our absolute experts to sort of discuss these topics going forward. So joining me today, in no particular order, Simon O'Brien, who leads the Marsh Valuation Division, specialised in insurance valuations, undertaking the valuations of over $100 billion of assets annually. Luke Stratford, who's very kindly dialing in from the States, where he's at a client site, leads Marsh Advisory Claims Solutions business, a dedicated group of claims expert professionals solely committed to settling major losses on behalf of clients. Catherine Osborne, a relatively new joiner to Marsh, we're absolutely thrilled to have her join Marsh, with over 30 years experience in insurance and reinsurance law and commercial litigation. Catherine brings together all aspects of our Marsh claims experience, aligning our teams involved in the delivery of our claims services and being side by side, which is really important, side by side, sitting in partnership with our clients in claims matters. And finally, obviously, by no means least, David Stamborough, who's had over 40 years experience working in the insurance industry, with significant experience placing complex programs for ASX top 500 companies across energy, oil and gas, infrastructure, financial institutions, heavy manufacturing, transport logistics, retail, and property owners. I'm very fortunate as being the CEO of Marsh Pacific to have with me some of the most talented people in the business, and this panel has collected those people together. Before I hand over to them to do the meat of the presentation, I've got one more quick question for you in the poll, which I think sets up very much where we want to get to. Quick question for you. When was the last time you validated your declared values for assets and business interruption? So when was the last time you validated, which is the important word, declared values for assets and business interruption? And again, we'll give you a quick 20 seconds to answer those questions. All right, Freya, I think we can go to the answers, please. Well, it's good. I mean, good that half of you have done it the last 12 months. What's most worrying, of course, is that 8% never, 12% 3 to 5 years ago, and 30% 1 to 2 years ago. So if we're talking about what we've just described in the earlier pool and what's happened, if we think about 42, 50% or 49% of you haven't done it in the last potentially 2 years. So something to really think about there. I'd like to thank you for joining us today. As I said, it's not about me. I'm sticking to my script and I'm getting furious messages about time. So I'll pass over to the panel. I'm going to hand over to Simon and Luke, who will talk through about adequately declared assets and business interruption values. We'll then have a series of presentations with some time for questions. The questions I really want to be, if they're specific to what you want to answer yourselves, we'll get back to you individually. We have, I said, over 500 people on the call, so we don't want to be talking about personal subjects and companies. But if you have any questions, we guarantee we'll get back to each and every one of you with any of your questions you ask. But over to Simon and Luke.
Yeah, thanks, Nick, and thanks for everyone, excuse me, for dialing in today. As Nick mentioned, today I'll have a chat to you about your asset values and what you declare and the impact that inflation is having on those and what we're seeing from a valuations perspective and from our clients' perspectives in the changing market. So to get underway, I'll start with the basics around what an actual valuation is or what the purpose of a valuation is. And ultimately, to put it simply, it's the basic principle is to assist you in determining how much you should declare the value of your assets for insurance purposes. So the most common basis of value that you would look at under an insurance policy to do this is what's called a reinstatement cost. So to put that simply, it's essentially how much it would cost to put back an asset, but brand new. So think of a building or a piece of machinery. We're not looking at what you would like to put back, or we're not looking at the condition of the asset. We're looking at what it would cost to put that back as a new asset. There's some additional elements that need to be taken into account, such as removal of debris and other inflationary factors that typically a valuation would capture as part of that process as well. So the most commonly accepted method in terms of how values are declared for the insurance market is an insurance valuation. So again, this is around determining the reinstatement cost of an asset. And I think it's important to note, a lot of us have had valuations or had exposure to valuations in the valuation market before. And And the most common thing you would think about is how much would it cost to buy an asset, or how much is something worth? So how much would it buy, or would I need to buy or to sell something? An insurance valuation is very different to that, or the values that you declare for insurance are very different. Again, it's the existing asset, but brand new. There's two, I guess, there's lots of reasons you would have an insurance valuation, or the benefits in having accurate declared values. But the overarching two premises, I think, are worth considering. The first obvious one is around minimizing the potential of under or over insurance if there's a loss. To put it simply, getting the right number. So making sure you're declaring for the right number as part of your insurance policy. The second element, which is quite often overlooked, is around providing comfort to the insurance market that you're going about determining your values in the correct manner, that they're being professionally determined. If there is a loss, there's a process in place that's assisted in what you declare. That helps the broking team, the placement team, and all involved from your advisors to make sure that there's no penalty clauses in the event of a loss, and that it negates any impact in you not getting that claim settlement payout if you do suffer a loss. It's easy to think about valuations and think about the buildings that we're sitting in now, the four walls and the roof, so to speak. They're the big assets. They sort of smack you in the face. You can't miss those. They're quite often high value assets. But it's not just the buildings that you need to think about when declaring values. There are a lot of assets such as equipment, machinery, elements of plant, and even fine art assets that need to be considered. In our world, in the valuation world, there's actually different valuers that specialize in these three different categories of valuations. Quite often we see our clients really focused on their higher value, big ticket building assets, but maybe not paying as much attention to, say, contents or fit out of leased premises or those ancillary assets. And they're experiencing the same sort of impact as every other asset as well. And over time, if they're not looked at in detail, can get a little bit out of kilter, so to speak. So next I wanted to talk about changes in value and what the inflationary market is doing to asset values and the values that you declare. Nick had up before the CPI percentage, and I think we all know it's sitting around 6% or 6.1%. So the key here is that construction's not immune from the impact of inflation as well. In fact, it's probably impacted as much as any other industry or a lot of other industries. And we've seen lots of media attention around this and material changes and costs of construction changing. So it's definitely not immune to the impact of inflation. Probably on a daily basis, I'm getting asked by clients, what index or what percentage should we increase our values by over the last 12 months? Whilst I'd love to be able to give the unicorn answer of this is the percentage that everything's changed by, it doesn't exist, in the sense that the industry that you operate in, the geographic area that you're based in, the specific attributes of an asset all contribute to the overall impact of inflation and the changes in construction costs. Whilst historically we might have been able to say that there's a general range of whatever it is, 3 to 5% or 3 to 6%, which is fairly narrow percentages to work within, what we're seeing now is a very vast and broad variables in those percentage changes. But this is a general statistics from the ABS, and even this alone shows that there's variances between 2% and 28% in terms of changes over the last 12 months in terms of asset values. So changes have been steep, but unfortunately there's no single index or percentage that can be considered. And you really need to think about the specific assets that you're insuring, where they're based and what industry you're in there. So touching on some of the factors that impact these changes and what's driving up these costs, I think for a construction project, thinking about it very broadly, obviously you could break it into 3 different categories. So materials, which make up roughly around, obviously it varies, but roughly around 40% of a project cost. Again, we're all seeing the media explaining changes for the likes of steel and timber and so forth over the last 12 months, and commodity prices fluctuating massively, in some areas of greater than 30%. It obviously has a major impact on those costs, and it can be a drawn out process in terms of those impacts hitting us. Whilst a lot of this has been down to supply issues, and we'd like to see that that's potentially easing up slowly, it's not going to change. I can't see it changing overnight, in the sense that we often don't understand that to manufacture a lot of these materials, it can be quite energy intensive. So we're seeing now, whilst supply pressures are easing slightly, we're still having now the dual impact of energy price changes that are going to continue to see a lot of fluctuation, I think, around these inputs into the material construction costs. The other element, which is typically the largest component of a construction contract, which is labour, it's not immune to the skills shortage that we're seeing, and I'm sure a lot of us have seen in the industries that we work in, and it's not a hidden fact that there's a lot of skill shortage across the board. I think the recent studies showed that 9 out of 10 building companies were experiencing a skills shortage. So that's obviously going to impact on wage costs. And when you think about this in an industry that's quite heavily reliant on projects and as such subcontractors, where subcontractor costs are changing and being variable for shorter projects, is definitely going to continue to impact on labour costs as well. The third, and probably the least amount of contribution to the overall cost, but still a very important factor, is the other inputs, such as the costs of borrowing, professional services, and so forth. So as we're seeing interest rates increase dramatically, we're seeing lenders put more scrutiny on developments and loans that they're putting out. This is going to have an ongoing impact on the cost of construction that projects probably didn't need to consider as much historically. These are construction projects, and I'm focusing there typically around buildings and large infrastructure, but it's not just the buildings element that's being impacted. The procurement of machinery and plant and contents and any sort of assets really apart from a building is still being impacted as well. Those supply disruptions have meant longer delays for imported goods. We're seeing last year that the peak of the shipping costs, which again is coming down a little bit, but we're seeing it again on a 5-year average being 100% higher than previously seen. So there's increased costs of procurement and shipping that's definitely impacting the procurement of overseas goods and machinery. Just to finalise on the points around, I guess, what we're seeing in the market. If you want to go to the next slide, please, Russell. What we're seeing, common mistakes in terms of values being declared and discussions we're having and quite often see. Again, I don't like reading through a list, but I think all of these are very valid, and we see these on a regular basis. So simply applying a percentage to previous values or valuations. So again, historically, if there was changes in the market of 5% per annum and values get updated by CPI, you might have been able to get away for a couple of years in doing that. With the fluctuation and the variances in the changes in the market, simply applying a broad percentage is now seeing valuations that we undertook previously, seeing large changes in those as well. Using a book value or a market value is another common area we see. Even if it's a book value, even if it's from your financial records in terms of an acquisition value from your asset registers, often these won't take into account construction change movements over the years since that acquisition date. So going back to what we were talking about right at the start with reinstatement values, it's the cost to put back the asset but brand new. So not the depreciated value that you might see in books. I touched on this earlier as well around not assessing all of your assets. So again, it's easy to focus, it's human nature to focus on the big ticket assets in front of us, the buildings and the sites that we're really focused on. But we've seen a lot of examples where there hasn't been a lot of attention on the lower value assets or locations. And because of that, for over a number of years, the values are now quite significantly out of line. Declaring what you prefer to replace an asset with. So again, your insurance policy is based on what asset you're insuring, not what you would like to put back. There's mechanisms in place around that you can have a chat to your broker with and with the valuation team. But really, the starting point is around replacing or reinstating that specific asset. These next two are relying on either internal or external anecdotal conversations. Even if it is incredibly accurate advice, quite often it could leave you a little bit open in terms of if there is a loss and having to say that you've relied on external conversations, that you can't really transfer any of that risk away from yourselves in a loss event. Second to last, the consideration of regulatory codes. So think of the building code, for example, and whilst you may have built an asset 20 years ago, or you may have some really good data, historic data and assets, if you're declaring the value of an asset of today, you need to consider today's construction codes and building codes as an extra cost of reinstatement. Another area we're seeing quite a lot of now is in the case of companies acquiring assets or merging assets. You might have a strong process in place around determining your insured values and assume that some of the companies that are acquiring do. It's worth paying extra attention to that, particularly in the current environment of the hard market, to make sure that their processes are adequate and are in place, and if not, that you'll bring them into your process, essentially. Just finally, I touched on, again, earlier around the importance of getting the right values, but also the impact of potential issues with your policy if you're not declaring the right values from the insurers. One of the things that an insurer can look to do is insert an average or co-insurance clause into your policy. In the soft market, we saw this removed from a lot of policies. However, we are starting to see it come back a little bit in situations where evaluation hasn't been undertaken. The most simple way to explain this is to give a very broad scenario. So if you looked at a full average clause, a co-insurance clause, and say you declared the value of a building for $10 million, and you think, okay, well, that's great, I've got $10 million cover, but there hasn't been a process in place around how you've gotten to that $10 million of cover. You have a loss tomorrow, and the loss comes out a $5 million loss, so half of the $10 million. The loss assessor comes out and assesses the loss and determines that, in fact, you should have been declared for $20 million. So twice as much as you declared from that $10 million, or 50, so you're 50% underinsured. So from that $5 million, then they can apply a proportional reduction in that claim amount. So instead of getting that $5 million, you'll get 50% of that $5 million, which is $2.5 million. Now that's a very broad and extreme scenario, and there's often percentages that can be put in place to cap that, which 85% is quite a common percentage. But a key, I guess, is showing the market that you've got due process in place to try and minimize this forming part of your policy. And if it is part of your policy, being able to negate the impact of it in the event of a loss. So that's it from me on my section. I'll hand over to Luke now to talk to you about business interruption.
Thanks, Simon. I'm very pleased to be with you today. And as Nick mentioned, I'm helping prepare a claim in the US for one of our clients. And a discussion about asset values and business interruption is really very, very important. Preparing claims is obviously the pointy end of where insurance really ends up either transferring risk as expected or leaving people disappointed. And I think a lot of the issues that we're talking about today are very, very important in ensuring that risks are being transferred effectively in the insurance renewal process. For me, what I'm going to focus on is really getting the declared value right and then also touching on indemnity periods and getting correct limits of liability. So what is business interruption? Business interruption is insurance that actually provides cover for cash flows. And these cash flows are there to meet the loss of profit and the costs that may continue and/or increase in the event of a loss. Why is it important to get it right? Business interruption insurance is critical to the ability of a business to survive a complex loss event. Although a fire might be extinguished, a flood may very well negate quickly, the impact of a business interruption loss can continue for very number of months, or if not years. We also know from claims that it's easy to buy insurance, but are you buying the right cover? Do you have the cover in the right places? And do you understand your risks? Will you be able to transfer these risks as you expect? It's not a good time to learn that your insurance cover doesn't work after you've had the loss. And the potentials of getting it wrong are complex. It may mean that you're wasting premium by covering a risk that doesn't exist, or you may be actually buying inadequate cover. And the declared value and your renewal document is an important communication between you and the insurer. Accurate declared values, whether they're assets or business interruption, help the insurer to understand the risk they're underwriting. And by having good and accurate values, potential complications when a loss occurs are minimized. And finally, on this slide, we understand that underinsurance is a very complex and very significant penalty if you get insurance wrong. I personally have been involved in claims where insureds have had less than 50% cover. So the example that Simon referred to has occurred on a number of occasions in my experience. And the failure to transfer risk, as you expect, will mean that you actually underwrite your own risk, and you will need to fund the risk from your own balance sheet or other sources of income. So why is it important to get BI right? It's important to get BI right because we want to maximize recovery in the event of a loss. We want to make sure that you get your entitlement under the policy. It's very important that when you go through your declared value at renewal, that you understand what you're insuring. You understand what your risk is and how is the policy transferring that risk. Because there are all sorts of different solutions to business interruption. Whether it's gross revenue or insurance gross profit, there are different solutions. And it's important that you understand what solution is being proposed for you. Next, it's important that you understand what's being asked. I really highlight the fact that you shouldn't just ask finance to populate a template provided by your broker. It's very important that whoever's going to complete the document understands what's being asked. I wanted to highlight that insurance gross profit does not equal accounting gross profit. And this is the biggest mistake we see, is someone asking finance to complete a document or a template without really understanding what's being asked. Next, the declared value needs to be calculated in accordance with the formula in the policy, okay? It's very important that you don't play the underwriter. It's important that you recognize that losses do happen. You have certain obligations under the Insurance Contracts Act, and it's very important that you treat this communication with the insurance company carefully. Next, All declared values are based on a standard 12-month period adjusted for the indemnity period. It's very important that you understand that if you have a 6-month indemnity period, you still need to communicate a 12-month standard value to the insurer. Next, the calculation needs to be forward-looking. So often with accounting, we're looking to the past, like driving a car through the rear vision mirror. For a renewal and for a business interruption declared value, it's very, very important that we're forward-looking, especially in times of volatility. We need to be looking at how will my business look in the next 12 months, the next 24 months, the next 36 months. And the reason for this is that we need to make sure that the values are adequate for what we anticipate to be the activity in the business. And then lastly, we need to make sure that we understand things like COVID, inflation. What if we have a recession? As we look forward over the next couple of years, we see a lot of volatility. We see a lot of uncertainty. We can see how the war in Ukraine has affected so many different parts of our economy. So it's very, very important when we look at the trend of the business that we're taking into account all these types of things. Next slide, please. Some of the factors to consider when looking at the calculation of your declared values. So COVID, there are a number of businesses which were closed during the COVID period. It's very, very important when you're providing your declared values to your broker and ultimately to the insurer that you aren't incorporating this trading that may have only been one-off during COVID. So for example, in your 12 months of data, you might have 4 months when the business is closed. Okay, so it's very, very important to recognize that within the data that you're relying upon, there may be COVID affected data. Okay. We also know that COVID produced winners and losers. You need to think about whether the period that you're relying upon, which may include this COVID period, is that going to be repeated in the future? We know, for example, that supermarkets did really, really well. Okay, but cinemas and restaurants did poorly. So how will COVID and the potential of that being in the data that you're relying upon affect the numbers you produce? Okay. It's also very important that we look at what could be the future. You know, what would happen if we had further COVID shutdowns or restrictions or supply chain interruptions? Okay, so these are the things we need to think about. COVID is not just in the past. It's something we're having to live with. Next, volatility and inflation. Now, volatility and inflation is always a challenge for many businesses. If you're a casino, during COVID, you were shut for a long period, for example. Okay, you may be in the oil and gas sector. We've seen the price of oil go through the roof. Okay, so how is volatility and how is inflation going to affect your business? How do I make sure that my declared values incorporate the potential for volatility and inflation into my numbers? Okay, again, we need to be forward-looking. When we look at our business, how vulnerable am I to wage spikes? Okay, if we look at inflation, we know that wage spirals often occur after inflation. How is my business going to be affected by this? And then as we see these cost pressures, we want to make sure also that we're not insuring risks that don't exist. Okay, have I actually looked at my insurance, my business interruption, and have I actually stress tested it to see not only has it got the right limits, but am I over-insuring in some areas? For example, I may have access to rent abatement. Does that mean I need to insure my premises in the event of a loss? And then finally, when we're looking at these numbers, make sure that we look at it from a partial loss viewpoint. Okay, we really need to be thinking about how costs will behave. And finally, on this slide, the indemnity period. We need to make sure the indemnity period is sufficient for us to get our business back to normal trading. Okay, we know that in many businesses, they will have a loss of market share if they suffer a significant loss. You need to make sure that your indemnity period is sufficient, not only for the things that Simon talked about in his valuation discussion, but also potentially for you to be able to recapture lost market share. Next slide, please. Other factors to consider when we're looking at business interruption during the renewal period: the limit of liability. From what Simon's talked about, and some of the things I've also talked about, there is the possibility that your values will increase. If your values do increase, is your current limit of liability sufficient to respond to the largest loss? Next consideration, contingent loss. We know from things like floods, cyclones, and bushfires that these can have a huge impact on supply chains and customers. Have you considered what the potential impact is on your business of your customers or suppliers being affected by these sorts of events? Next item, deductibles. Do you understand how your deductible applies? Do you know what the dollar value is of your deductible? Do you know where your cover starts and how it's to be applied? And then finally, with inflation and the time value of money becoming increasingly important, we know that we need to get claims paid faster. Okay? We need to know that we need to focus on getting claims resolved quickly. And part of that is having the right declared values, them being accurate and timely and an effective communication of the risks that we're expecting the insurer to underwrite. I'll go to the next slide, please. We just wanted to discuss a couple of case studies here, and I'll take mine first. And this is an actual example. So this is a global client that I've worked on for almost 15 years. And this is a client who has always been committed to making sure that they take regular asset valuations and reviews of their business interruption risks. They recently suffered a loss exceeding around 100 million Australian dollars. Now, because of the commodity price cycle that we're in, their declared values actually were incorrect. Okay, so although they had done declared values at the time of renewal, because of things they couldn't foresee, and primarily the war in Ukraine drove this, we saw that the values were actually inadequate. But because the client had actually committed to having frequent reviews of their asset valuations and their BI, there wasn't a problem with insurers. David, maybe you can comment on how important it is to invest in this relationship with insurers.
Yeah, thanks, Luke. The important part coming out of that one, there was obviously shock value at the time the loss occurred in terms of the declarations, but the transparency and the history of the client of the market and the annual insurance declarations and presentations, it wasn't, apart from the shock of the loss, the shock of the actual commodity pricing was validated by the fact that no one foresaw some of the explosion in the commodity pricing in the client's particular product, that the client could actually show and reflect past history over a long period of time, what the average pricing was for their product over a long history. Therefore, the market had a lot more comfort around the claim. As you know, when insurers have losses, there's a lot of spotlights put on in various places in underwriting worlds, from CEOs downwards, as to what happened and why and what the declarations were. The good thing about this one, we weren't broking the values, as to speak, in terms of the claim. It was just accepted. It was understood by the market that this happened, and it was a bit of a shock value. But the fact that we had a demonstrable history that we were trying to declare the values accurate as possible at the time of the renewal. As Luke understands, working on this claim, that we haven't had that big battle of insurers in terms of under declaring.
Simon?
So thanks. I've got a case study here around valuations. It's a client that it's been a client for a number of years now, and we've got an extensive program in place where they undertake valuations of their assets annually, or a selection of their assets each year. So they've got quite a rigid process in place, and they've gone on to then acquire quite a large new business. So they've added, I think there's about a dozen locations to their business that they went through a stringent M&A process and put in. Through that process, they had the view that the client or the firm they acquired had let them know that they had a process in place around insurance and values and so forth. However, they wanted to bring the process in determining the declared values within their program. So they engaged us fairly early on to go and have a look at the declared values for the business they had acquired and undertake the valuation. So on result of this, it actually determined that the values they were declaring were materially under what they should have been. This was obviously exacerbated by the inflationary costs and the impact of that. However, I think a key while this was a bit of a shock to them and something they had to deal with, a key element of this process was that they acted early within that process. So it wasn't a couple of months out from renewal that they had this problem that they had to start looking into around how to start declaring those values. So, and David, maybe you can comment on the importance of timing and having that information for the placement.
Thanks, Simon. There's a dual actual case in this one. Not only was a client a little bit taken aback by the valuation of the assets they'd inherited in terms of that they were significantly undervalued. The fortunate thing was it didn't breach policy limits, but that was a good outcome. But it allowed the client to focus on what they were insuring and the adequacy of what they were insuring, whether they needed to have R&R on certain sites or have indemnity value. The other dual problem was also the client had improved the rate of gross profit substantially at these sites as well, and also relying on the historical data was incorrect, and there was a significant increase in the BI values as well. The end outcome is the client could then tailor months outside of the renewal, tailor the exact limits they wanted to buy for the market, validate those limits, and gave us a better run into the market around validation of the cover we wanted. So what could have been a rather significant cost blow and premium wise, we were able to mitigate that by reviewing the basis of what we declared, how we declared it, and also particularly around the business interruption part. So it was a good outcome. But as Simon said, timing was the key, because we had plenty of months to consider alternative ways of declaration, etc., in terms of the BI side of it particularly. So it modulated the outcome. It got the shock value out of the way early and got the shock value out of the way of the market. In this particular case, the market was understanding and didn't try and apply for an adjustment of the current period. So we've got that wave, but it certainly saved a few dollars on that front as well.
So,
thanks, guys. Thanks, Simon.
Excellent. So just touching on a few considerations quickly and just recapping some of the elements we spoke about. In terms of valuations, these first 2 points are really about taking away a review of when you last undertook a review of your declared values and working out how you've come to those values that you declare. Has a valuation been put into place? The other 2 points I'll touch on considerations quickly, really around timing again. So evaluation doesn't need to necessarily be undertaken 3 months out before your renewal date. A lot of our clients get a lot of benefit from thinking about this even shortly post a renewal you've just been through. So it doesn't necessarily, there's no specific time that you need to wait and wait until a month out from your renewal, or even 6 months out. We can work with you, and your brokers and team can work with you around timing. The more time that you have in preparation, the better result you're going to get. There's finally, we talk about inflation over the last 12 months and the impact of that. The declared values aren't just a snapshot as at today. So a policy will typically go for 12 months. So you need to consider the value of your assets at the end of the policy, plus the impact of inflation if there was a loss on the last day of your policy during that period of time that you would need to rebuild those assets. So there is a lot of inflationary, future inflationary considerations that need to be thought about when determining declared values.
Just quickly on the business interruption, just a couple of points. The first one is get the numbers right at renewal. If after renewal you feel as though your declared values aren't accurate, you need to think about actually updating them. If you're in a volatile business, if you feel as though it's hard to forecast where you're going to be, think about using the premium adjustment clause. And finally, you should take a structured BI analysis or review with an expert. Having a paper trail, having the support for explaining why you did what you did is important.
Thanks, team. A lot to think about, and we've been emailed some questions separately, but by all means, send them through on the Q&A function if you have any questions. Just a question for Stan, and this is in no particular order, and they're just coming through, and I'll read them as they come through. What is the expectation from the insurance market with regards to requirements to having valuations? So I guess they're saying, is it expected or something that, it's not nice to have, it's expected, right?
Yeah, thanks, Nick. I mean, the insurance market just coming out of the hard cycle to a more stabilised cycle. They were fascinated by rate adequacy and coverage changes, etc. Now the new fascination from every insurer is that they cast doubts on the declared values from renewal if we don't have a recent valuation. So they're a very suspicious lot. So, the first question they're throwing at us, if clients are only lifting asset values by a certain percentage well below inflation, they've got doubt on the value straight away. So the underwriter's expectation on property is that it's had a valuation, prefer minimum of 3 years, out to no longer than 5 years. It doesn't have to be every single site. They want the main sites validated. It's more validation and giving the comfort that the values are accurate. If not, as Simon's alluded to, they'll apply co-insurance clauses, or attempt to apply those, or they'll load the rate up for what they feel is under declaring. On the BI side, it's very important that, as Luke said, it's validated properly. It's done on insurable gross profit, not accounting gross profit, and make certain that the values we're declaring are, because underwriters now want the values extrapolated out for indemnity periods. That from a client's perspective, what we're declaring is accurate, also relevant in terms of the indemnity period. So clients just want to know. So underwriters just want to know that the clients are spending the time validating the BI side of it. So it's validation and comfort from an underwriter's perspective of what they want. And the cycles there's a trail there from us that we can prove that the client is getting regular valuations done, no worse than 5 years at the extreme, but more around the 3 years. And on the BI, there's been validation where it's a full-blown or a desktop, some validation of the numbers.
Thanks, Stan. I guess one for you, Luke. How do we capture values if they're changing regularly and quickly? And will the insurer punish us if they see constant change?
Thanks, Nick. Look, it's a really great question. I suppose the first thing is to make sure that you're communicating this with your broker, so the broker understands that this is one of your challenges. The next one is to think about whether through the process you actually update your values if they look as though they're going to be materially different. You can use the premium adjustment clause, or you could actually basically provide an initial calculation and then adjust it at the end of the period. So I think the most important thing there, Nick, is to make sure that you're communicating it with your broker, and that the insurer also understands that you're wrestling with this problem and that genuinely you want to get on top of the problem. And what we see is that when insurers see it as a true partnership, that they're prepared to understand.
Thanks, Luke. Catherine, so one for you, which I guess is all encompassing of everything we've talked about. The question comes through is, how do we reduce the claims costs, which is obviously a rather large topic, but in terms of, could you give us a brief, your thoughts on that?
Thanks, Nick. Look, I think there's two main ways to reduce claims costs. The first is in the pre-loss scenario, and the examples that Luke and Simon have just given are perfect examples for what you can do pre-loss to reduce your costs at the other end once a loss comes in. Just accurate declared values, indemnity periods, those sorts of things will mean that once you suffer a loss, you don't have to spend time negotiating with the insurers about whether you've got the right values or not. That's all eliminated. It's really important. Second thing, for post-loss, when the claim does actually come in, it's really important to engage with us as soon as possible. Contact your broker, because through the broker our claims specialists and our forensic team, we can help you right from day one, look at the nature of the loss, get the claim strategy going, align the loss with the wording, appoint the right experts, notify the claim, but importantly, keep the communication channels open with the insurers so that we're able to get interim payments for you and progress payments. Because right now, what claims inflation is meaning is that the time value of money is critically important. And you want to get the money out of the insurer's bank accounts into your own. So look, I think it's fair to say that the longer a claim takes, the more it costs. So what we're about is trying to get claims paid for you ASAP.
Thanks, Catherine. Another one for you, Luke, which is about 4 or 5 along the same sort of lines. Excuse me, I'm losing my voice. What happens if you use the wrong financial base innocently, or you choose the values and innocently undeclared? What can you do about that on the journey?
Yeah, well, this is something that often happens. People are doing what they think is the right thing, but they haven't had it reviewed or validated. Look, if you find that your numbers are wrong, that you've incorporated the wrong trend or the wrong data, I think that it's important you reach out to your broker, and then you address it as quickly as possible. Whatever you do, don't ignore it. We've seen time and time again with claims that if the values are manifestly wrong and you knew about them and you didn't do something about it, that the consequences can be quite dire. So I think that the most important thing is to reach out to your broker, and then we can work through a strategy of tackling this problem. There are ways of fixing it, and as I said, there are different mechanisms available. But the important thing is you should know what you're declaring. You should be aware of where your business is at today and where it's likely to be over that whole renewal window, to ensure that they're appropriate.
Thanks, Luke. Simon, one for you, and again, it's come through in a slight couple of different ways. Are there different ways of determining different basis of values?
Yeah, it's quite a common trend at the moment. We're seeing values increase, obviously, as we mentioned. So it's quite a common question we're getting from clients. I guess the short answer is the most common way to declare your values is on that reinstatement cost. It's what the insurers are looking for. There are differing basis of value that you can look at if you wouldn't want to replace that asset necessarily in a like-for-like scenario, whether it's an indemnity-based value or a modern equivalent-based value. It's definitely not the most common way of looking at things, but there is options around that. And I think in a similar theme to what Luke was just talking about there, and we've spoken about throughout this presentation, communication is critical in this element. I think there's ways that we can assist in looking at different bases of value, but it's important that it's not something that you consider and not let anyone know about necessarily, and that your broker, the insurance market, and your valuer, the whole communication channel there are aware in which the basis that you are determining the values, and you're minimizing any contention if there is a loss, because everyone's across the way that it has been determined. So if it's outside of that typical reinstatement cost approach.
And just following on from that, just come through, how often, I think you probably covered this, but just briefly again, how often should we be undertaking valuations? Is there a set period of time? Is it something that if we haven't done it, we do it now, or what's your advice?
Yeah, typically, and David mentioned this before, typically we would recommend every 3 years, but you still need to look at updating your values in those interim periods. So if you did undertake a full valuation for an upcoming renewal, next year you still need to consider the changes in the market. So there's mechanisms in place, such as a desktop valuation review that you could undertake for say 2 years, but we typically wouldn't suggest waiting any longer than say 3 years to have a revaluation undertaken. Again, this in some instances this might stretch out if you've got a high volume of assets. In other cases, it might reduce. So you might look to undertake the valuation every 2 years. And we've got clients that undertake the valuation, the full valuation of all of their assets every year. Other clients that look to update values almost on a quarterly basis. So it is It does depend on your assets and your risk appetite, but typically would suggest not much longer than 3 years if you can avoid it.
Thank you, team. I'm just conscious of time, and I'm being shouted again to get back to the script and close this down. But I must say it's a fascinating topic. We're very fortunate at Marsh to have, as you've seen today, absolute experts in the field. And as I said at the absolute beginning, this is not a sales job by Marsh. We are your risk advisor and your partner. Our job is to basically help you and work with you, presenting your risk in the best light possible to the markets, not just now, but also, as I said, with a glimpse of your future. The key takeaways, they're there. I'm not obviously going to read them out to you, but obviously the key most important we talked about today, how important it is to accurately declare assets and BI values. We want to make sure everyone's adequately insured and have efficient, effective and timely claim recovery, as Catherine mentioned. We don't want the money sitting in insurers' bank accounts. It needs to sit in your accounts, getting your business and your people back to work. There's a few questions that came through which were specific, which we'll deal with, and we'll come back to you with answers to those questions. Any questions you have around anything that's been discussed today, please speak to your Marsh representative or whoever you deal with, or send an email to contact Marsh. Speak to email to marshaustralia@marsh.com. We will get back to you with any specific questions. There'll be a recording of this. You can also get hold of Luke when he's back from obviously the States, Simon, Catherine, David, myself, any of the team. This is the most important part of our job, in terms of it's understanding our clients' needs, understanding what you have, what's going on, what's your business is going, where it's going, and then standing alongside you to give you the best possible advice around the risk of those businesses. I said at the beginning, I'm very fortunate at Marsh. We have incredibly depth of talent in this space. We have a valuations team. We have a huge advisory team. We have a team that can help you with anything. And the great thing about Marsh, it's a global company. We can pull in experts from all around the world. So thank you very much for your time today. I really appreciate it. We'll get back to those questions that haven't been answered. Please come and speak to us about any of the issues on this topic, on this takeaways, and also anything we can do to help you with your business going forward. But thank you for your time. We've greatly appreciated, and we look forward to speaking to you all soon.